Hi, I'm Eric Ravengard, and I'm the CEO of Athena Bitcoin. Thank you all for coming to this event. Wish I could be there in person, but as you can see, I'm actually still in my hotel room in Los Angeles. I'll get to why that is in just one second. Um, a little bit about Athena Bitcoin. We've been helping clients buy and sell Bitcoin since 2014. We operate digital currency kiosks, otherwise known as Bitcoin ATMs, in the US, Argentina, Colombia, and Mexico. And in 2018, we launched an investment banking unit to do some boutique investment banking within the cryptocurrency and digital asset space. Since you can't come and ask me for my business card, I would invite you to check me out on LinkedIn. My username there is Gravengard, or on Twitter, eGravengard. Uh, Again, apologize for not being in Chicago today. I woke up this morning to find that my flight had been delayed by 5 hours, and all the other choices would get me in about 5 minutes before my expected 6 o'clock arrival. So, my apologies for that. Uh, I hope that you are still having a good time learning about what's going on in institutional investing within the digital asset space. I have a few words about custody, which is on the tip of everyone's tongue right now, with recent news from Fidelity. And then finally, I'll give you a little bit of an overview of what's going on in the digital token and securities token market, the STO market. First up, custodianship. Everyone's very excited that Fidelity has announced, after years of sort of hiding in the shadows and being whispered about, they've actually announced that they are going to become custodians for digital assets in 2019 for institutional customers. And so let's step back and just ask, what does qualified custodianship mean? It's very loosely defined as someone that will hold an independent account, whether that's a bank, a broker dealer, an FCM, or something called a foreign financial institution that customarily does this. We'll ignore the last part. We'll actually ignore FCMs for the moment because they can't hold, we don't think that they can hold digital assets in the form of securities or tokens or things like that. So basically a bank or a broker dealer that can maintain an independent customer account. Now, there are many things that custody is not. It does not necessarily come with SIPC insurance for the full amount of your digital assets. And while there are some insurance guarantees with some custodians, they're not the same everywhere. And sometimes they don't defend against actual cybersecurity from third parties. They might be fidelity insurance against employee theft, but perhaps not against state actors. Certainly, if we were to say, Fidelity by the end of 2020 has $500 billion of digital assets, that's quite a large honeypot, and that's a large honeypot for even a state, and by state I mean China, Russia, North Korea. That would be a large asset for them to go after. Not to mention, just every amateur, from here to Nairobi would be after that. So let me talk really briefly about some of the institutional adoption we've seen. And by institutions, I mean, major endowments, Yale, Harvard, Stanford, MIT have all announced either investments in venture firms or in cryptocurrency firms. And those tend to be long only firms, not the high frequency trading firms, like the one that I've been a part of for the last 3.5 years. That's very exciting. I think what it says is that the cryptocurrency, the digital asset market, is an important one. It's one where smart institutional investors think there's going to be alpha to be had, and certainly there's a place for uncorrelated returns. And so I think that's why we're seeing investments in these. And the other thing I would say is that most of the venture firms that they those endowments had been previously invested in had told them that they didn't believe it was within their mandate necessarily to invest in a new cryptocurrency. It's not equity. It's certainly not preferred equity. And those are the types of things that those venture firms felt were in their mandates. Now they had made certain investments, at a small percentage of total assets under management that were in tokens and other things. But in general, the market felt that there was a need for new funds with new risk mandates, new controls, and we're seeing those large endowments start to put money into those funds now. I think it's a really exciting point in this cycle when we see those types of investors, validating the space. It's not fake money that will disappear overnight. I think the other thing that we've seen in this market is regulatory clarity, by which I mean, ICOs that are marketed as investments are securities offerings. I'm not sure why everyone was so confused about that in 2016. I think everyone thought, oh, it's new, so therefore it's not like the old. But I think Jay Clayton and his staff have made it very clear that if you say invest in my project, invest in my token, or use the word invest in almost any context, you're probably talking about a securities offering. And if you're talking about a securities offering, there are laws that need to be followed. And those laws are have been in been on the law books for a better part of 80 years. And so there's a lot of clarity coming out of the SEC in that regard. There's less clarity about how a token navigates from being offered in a security offering as part of an investment contract to being a commodity. They have said that Ethereum and the Ethereum network, now that it is fully functional and being used on a daily basis for things that are not just investments in Ethereum, that the Ethereum token itself is not a security. However, when it was offered to the public, that was probably a securities offering. And so how we go from point A to point B, no one's quite sure. And that's the only place where there's not a lot of regulatory clarity. But where there is regulatory clarity is that if you are raising money for a project, either as an ICO or something else, you're making a securities offering. And so the focus of Q3 and Q4 of 2018 has been security token offerings, basically saying that I am raising money in the form of a token, and that is also a securities offering. And the token itself will represent some ownership of something, whether that something is equity or a percentage of royalties or a percentage of revenue or profits or some other fixed income like structure. The token will represent an ownership in that. That's because everything is now a security. And I would say almost all of these are being offered under Regulation D, which is an exemption from public registration. That's private placements. And the primary focus of a lot of these offerings is secondary liquidity. How will I, as an investor, get out of this investment, without the company being bought? And so there's a large focus on being able to trade these securities after certain lockup periods on certain new and emerging markets. Most of them are ATSs, and I'll get to that in a few slides. So let's just talk really briefly about that path to secondary liquidity. Most of this is encapsulated in Rule 144, and a security that's held by an accredited investor for 1 year can then be resold to anyone, the general public. Regulation ATS, or alternative trading system, allows certain broker-dealers with the right registrations to match buyers and sellers of these, private placement securities in an open and continuous order book fashion. There are no ATSs that are presently trading, but there are probably 5 or 6 very exciting companies that are that have ATS licenses and that are working towards secondary liquidity for at least the handful of tokens that have been issued 9, 10, 12 months ago. So let me do a brief case study on what one security token might look like. Let's imagine a hypothetical private REIT. We'll make an offering under Regulation D. We'll raise a $40 million equity tranche for what might be, a two building condo development. Maybe 60% will be in bank loans, and the remaining will be in equity. We can also review some REIT investment rules. The two most important that I think are going to impact the dynamics of this are that you must have a minimum of 100 investors, and your top 5 investors cumulatively have to hold less than 50%. And so you have to have a well-diversified set of investors, but for other reasons, you have to have fewer than 2,000 accredited investors. Let's say they did the private placement December 1st. You're going to allow first resale of those tokens not until the end of 2019. So as a result, the state of both their token technology and their which exchanges that they're offered on doesn't really matter for the next 12 months because it won't be open for trading. Investors can certainly verify that they own shares in this REIT, but they don't need to necessarily use the token. And by token, I just mean a replacement for a paper stock certificate. It's my belief that paper stock certificates are antiquated and that we should represent those things digitally. Right now, you could represent that digitally in the form of book entry, which does not mean books. It usually means Excel spreadsheets. And so you can either be represented as the owner of this REIT and in book entry by having your name on row 16 and your name in column A and B. Or you could own a digital token. And a digital token might be something that would be issued under the Ethereum network. And so you could use your smart wallet to verify that you own it, to transfer it in and out of your account with a custodian or an exchange, or you could trade it yourself directly to a counterparty, possibly through some intermediary if you wanted to do something more complicated with escrow payments and the like. So when we say tokenizing security, we really just mean replacing a paper stock certificate with a digitalized representation of the same. So let's move on with our case study. What would be the advantages of representing a paper stock certificate in a tokenized form? Well, one would be the reductions in frictions of transfer. I bought Facebook stock about a year before it went public, and one of the largest problems that the law firm that was handling Facebook's transfers at the time had was just verifying that the original investor owned his stock, finding the right size seller. When we went to our broker and said, okay, we would like to buy $500,000 of Facebook stock, they said, well, we don't have anyone that's selling that exact amount. Would you like to buy $300,000 of Facebook stock or $700,000 of Facebook stock? There's a lot of frictions that are involved in negotiating in these private transactions, not to mention paperwork. They need to make sure that the previous owner's name has now been erased from all copies. of the Excel spreadsheet. They needed to make sure that our names were properly recorded in that same Excel spreadsheet, that there were copies of that Excel spreadsheet that were numerous, and that they had good books and records around this transfer, so that in, when they eventually, when Facebook eventually does go public, the previous owner doesn't call up and say, hey, what happened to my ownership? So the advantages of tokenization, we can reduce those frictions enormously by putting all of that confirmation and verification onto a blockchain. Standardizing around certain token technology, which we have with the ERC20 standard, also allows for interoperability of these tokens. If you have a token in one venue, you could bring it to another venue if the original venue just doesn't have enough buyers and sellers. So I think that's very exciting. And then finally, and this is where I think everyone's most excited, is that sellers can find buyers for their securities and they can get liquidity for their token. Now, I say probably on this slide because in our case study, we're still looking at a $40 million REIT. Maybe it's in Chicago, maybe it's in Miami. It probably had 300 investors. How much active trading is there in most assets that have a market cap of $40 million that have 300 investors? And the answer to that is there's really not that much trading. I don't expect high frequency trading firms to be making active markets in these things. I don't expect there to be a lot more trading than by appointment only. What I do expect, however, is that this is a more efficient way than calling your attorney who originally introduced you to a real estate developer and saying, do you have any other clients that want to take me out of this investment? Because I think that process could take months. And I think in this sense, you could, in fact, post your tokens for sale on a venue and see if there are bids against that. Some of the exchanges expect active trading, and some of the exchanges are contemplating more of a negotiation between buyers and sellers that might happen similar to many different negotiations in the over-the-counter market for different securities. I've mentioned that there are these things called ATSs that want to offer secondary trading. I want to briefly give you a little bit of the lexicon in this space. There are services called primary listing services, which help companies to offer their securities in an initial offering. You could think of that as sort of the IPO market, but for private shares and private placements. And then there's venues for secondary trading, and sometimes venues can do both. Here are a couple of the names to watch. T0, they've partnered with the Box. Since we're all in Chicago, the Box is the Boston Options Exchange, which is headquartered up on LaSalle. So a little bit about the year ahead. Digital assets are here to stay. I think that's become very obvious. The price of Bitcoin will go up and it will go down. I don't know where it's going to go over the next year. I think that a lot of things in the digital asset space are still at the proof of concept stage. It's still not possible for anyone to go into their Fidelity accounts to buy and sell a security token. We don't have introductory brokerage models where you would even be able to, start out with all of your funds at Fidelity, make a trade on the OFN, the Open Finance Network platform, and then have that asset be put back into your Fidelity account for them to custody and send you nice statements about. This is all still in proof of concept. I think that will be true for the next year. So what are and then the other thing that people have asked me, like, what are the major risks for investors? And I think right now it's the fear of missing out. We're still in the very early goings of this. I think that there's a serious risk that by not understanding it this year, you won't understand it next year. And if you don't understand it next year, then there will be investments that you'll miss. just because you don't understand them. That said, I think that investors also need to worry about, the projects, the companies, and the things they are investing in, that they not get stuck in some regulatory morass. Um, Michael Arrington um, has recently said that he's moving all of his investment funds and his new investment firm offshore. And the reason for that is every time he makes an investment, he gets subpoenas from two or three regulatory organizations that would like to know more about his investment. And it's possibly because he's invested in a few things where questionable things have been done. But it's not always obvious to everyone in the room what those questionable things are and are not. Especially when you are talking about cryptocurrency, the prevalence of foreign investors in these markets, what was said to whom and when. Did Michael Arrington go to this meeting whenever? Those are not the questions that a lot of investors want to be answering. And so I think there's really two risks, and they are on opposite ends of the spectrum. You're either going to miss out if you don't make any investments in this and you don't learn about it, but at the same time, choose wisely because you don't want to be stuck, answering questions about why you made this investment decision, even if it was a minor investment decision. With that, I will wrap up my remarks. Looking forward to possibly being late to this party. News pending on that. Thanks.